The Treasury yield curve for the 10-year notes inverted for the first time since 2007, flashing signals of a possible recession within a year or two. This coming on the heels of the U.S. manufacturing PMI falling to a 21-month low, causing concerns about global growth. Joining us now, Brandywine Global Portfolio Manager Jack McIntyre, and UBS Financial Services Managing Director Jason Katz. Jack, let's go ahead and start with you. What do you think is happening here today? It's a day that concerns are not just about the U.S., but globally right now, and you can see the market is certainly reflecting all of this action.
So you're right. I think there was a decent amount of complacency across different asset classes. If you look at the volatility measures in bonds, equities, currencies, they were extremely low. So I think today is a little bit about reminding that, markets aren't just one direction. I mean, you look at equities, and they've had a tremendous rally this year. They've discounted a tremendous amount of good news in here. As it turns out, hey, maybe there's a chance that we are going to see an economic slowdown. I mean, again, if the message embedded in the yield curve, it's the slowdown, but I actually think it's also the low inflation. Inflation expectations are still well anchored, gives the Fed ability to cut if they need to. But again, I think it's concerns of global economy. The sell-off in equities isn't based on the U.S. data today. It's based on what's going on in Europe and this perception that the global economy is going to continue to slow down. U.S. isn't this economic island. We're not going to be immune to the slowdown, and it's going to put pressure on our economy.
Okay, Jason, inverted yield curve, that gets investors' hackles up, certainly. It may not be a signal that, the market is going to implode, but it's certainly not helping.
The inverted yield curve is not the best prognosticator. It's predicted roughly half of the recessions. The fact of the matter is banks are not going to stop lending tomorrow, but in the long term, if rates remain inverted, that certainly could be the case.
Okay. Where do we go from here in terms of this market? Because we've seen this kind of volatility before. The market can't seem to get a stable footing, and that can become troubling in and of itself for investors.
So I think with equities, again, I wouldn't paint an overly bearish view. I think we've rallied. We probably sold off too much in Q4. We probably rallied a little too much too quickly so far this year. I think the U.S. So our base case, we're not looking for a global recession. Certainly not looking for a recession this year in the U.S. So again, I think we have more downside to go. I wouldn't be looking to use my dry powder yet in terms of buying equities. But I like treasuries. I think treasury yields should be a core part of the portfolio. Okay, let's just pause for a second because President Trump attacking the Federal Reserve again in an interview with Fox Business. Let's watch this.
We finished up at 3.1 GDP. Everybody, that hasn't been done in 14 years, maybe more than that, but 14 years. And I think we have tremendous momentum right now. And you're right, the world is slowing, but we're not slowing. And frankly, if we didn't have somebody that would raise interest rates and do quantitative tightening, we would have been at over 4 instead of at 3.1.
Okay, a couple of points to make there. He's saying the world is slowing, but we're not slowing. Well, if the world slows, we will slow. So I think that's one issue to address there. And the second issue, of course, is, Fed action, right? At some point over the course of the last decade, interest rates just cannot stay at zero forever. So there had to be some tightening here, and the president continuing to criticize Jerome Powell, even though he's backed off.
I mean, clearly that's a bit of a communications technique. The fact is that the Fed went from being potentially the biggest risk to the market to being our biggest ally. But the flip side of that is we need to watch what we wish for. Is there something they're seeing that we don't? We clearly weren't able to export our growth last year that we enjoyed, and now it looks like we're importing a little bit of the world's economic slowdown.
Okay, well, GDP on an annualized basis was actually 2.9% in 2018. When measured from the fourth quarter of 2017 to the fourth quarter of 2018, growth was at 3.1%. So, Jason, your projections on GDP?
We're looking at the triple twos. We're looking at 2% growth this year, next year, and we think inflation remains at the Fed's target around 2%.
Okay. And Jack, your thoughts on Trump's nomination of Stephen Moore for the Fed board?
Yeah, I think it's a net positive. I mean, he's obviously got, I think, the right kind of experience to come in. I think what I like to see from the Fed, and I think the Fed probably did make a mistake, certainly tightening in December, maybe even in September. I think the Fed needs to realize that disinflationary pressures kind of are more important than cyclical. I think maybe Stephen Moore I think he sort of gets that.
Okay, I guess what I'm sort of, pondering here as we're having this conversation is this idea of the global growth that's impacting the stock market today. This is not a new conversation, right? A couple of months ago, we found out China is slowing substantially. We know that Europe has been slowing as well on a regular basis. So what is it that triggers the sell-off on a day like today?
Well, I think people are coming to terms, as Jack alluded to before, that we've had this, I won't call it parabolic, but 20% rise off the bottom. The target that we had for the S&P for calendar year 19 has come to fruition in the first 3 months of the year. So I think this is a realization that we're late in the cycle and that we perhaps went a little too far and too fast, and it's an excuse to book some profits.
Okay. Please,
yeah, I would actually say, because you have to think, what's the mechanism? So you've got a global economy slowing down, and you've got the U.S. economy that certainly is relative to the rest of the world is doing okay. What's the dollar? Because in that environment, if U.S. economy is doing better relative to the rest of the world, the dollar is going to strengthen. That was last year's story. Well, that's a tightening embedded as the dollar rallies. It had a good year last year. If it continues to rally, that's a tightening of financial conditions, and that's going to put pressure on certain parts of the U.S. economy.
Okay, gentlemen, thank you so much for joining me on this particular day. Jack McIntyre, I'm so sorry about that.
Right.
And Jason, great to see you, gentlemen.
Pleasure
Please
to be
come
here.
back again.